It's kind of a fascinating moment here, considering a week ago, I think people were plausibly saying, oh, the Fed's behind the curve. They're belatedly going to go into tightening mode with inflation where it is. Today, we sit here, people worried that the Fed's on the verge of making a mistake because we're worried about, the slowdown that might be in train after this latest COVID surge. Just give me an overview on where you see macro heading into 2022. And is this a bigger payback phase or just a pause?
I think it's a pause. We published our outlook piece last Thursday, and the message is we're seeing a tightening of financial conditions globally, right? The 24 central banks we track, about half of them are now raising rates. So that's new information in the market, and that's going to be unsettling to many. Where we're focused, though, as a firm is there's still a huge amount of liquidity on balance sheets. And if you think about just the G4 central banks, the Fed, the ECB, Bank of England, and you think about that in the Bank of Japan, they've increased their balance sheets by $13 trillion. That's 29% of those economies' GDP. So that's point one. Point two is we're starting from real rates at extraordinarily low levels. This is actually unprecedented. And so some of the earlier conversations you were having about biotech being out of favor and then cyclicals, that's going to happen from time to time when you have these uncertainties. The final thing, Michael, I think is just this recovery, which is the title of our piece, is going to be a lot different. We've front end loaded the spend, right? Consumers in the U.S., for example, have almost $3 trillion of excess savings starting the recovery. They paid down their debt and their house prices are up. And frankly, what we see, we own almost 200 companies globally. We see more of a labor shortage than an excess of labor. So I think you're going to see spending. I think it's going to come in different forms depending on how the variants mutate. We fully expect that science will catch up with the mutations, but we think it's going to be a bumpy 22. Just remember also that we were up 20% in 2020. We're up, 22, 23%, and people are cleaning up their books ahead of year end. That makes sense. We'd have more volatility. When we get into next year, though, I think there's some key drivers, and we can talk about those.
Yeah, well, what are some of those? I mean, I know that, you pencil in a 4,900 target on the S&P 500 with good earnings growth, so maybe the valuation comes in a little bit. But do you think that comes in the context of inflation actually receding quickly enough in a satisfying way?
I don't think inflation is going to recede as fast as some of the bulls think. There are really two things. One is about a third of the inflation measurement is housing, and we're very constructive on housing. We're investing aggressively behind that on a global basis. The second thing, as I mentioned earlier, is labor. Wages are going up, right? And we see that. That's very different this cycle. Particularly at the low end, you're seeing wages rise more quickly. And so investors should expect that. We're using a 5% CPI in the U.S. for next year. The consensus is 3.6. It will come off towards the second half of the year as energy prices and other commodity prices ease a bit. But there's a structural stickiness to the inflation that we're forecasting. And as CIO of the balance sheet, we're allocating to areas where we can own inflation protection more. Real estate credit, infrastructure, asset-based finance, some of our longer duration private equity. And so we think that this recovery is different. But we think there's a lot of opportunity around that. And that's the way we position the firm.
And so what areas would be net losers, let's say in public markets, from a 5% CPI? I mean, obviously that means nominal growth is probably really good, but, some things maybe get knocked loose along the way with a 5% CPI.
So a couple areas to focus on. Number one is if you can't control your labor costs, that's going to be an issue. Number two is if your unit volume is slowing, right? Right now, unit volume is strong, and if you're in the areas where consumers are spending, you're going to do just fine. We've tried to look at the world very simply and say they're price makers, people that can set price, and they're price takers. A lot of consumer staples are price takers. We see price makers in real estate, industrials, certain parts of tech, some of the commentary you guys were making earlier on cloud. We think those are all going to do really, really well. But this recovery, for those that study history, will look a lot like the 2003 to 2007 recovery, where at that time, China was building out its fixed investment, and it was creating a lot of noise around input costs. This is the same story this time, but it's the global energy transition, right? We're spending as a global economy $1 to $2 trillion per year building out the renewables. Yet we're living at a time where 81% of global energy is still coming through old economy sources: oil, natural gas, coal. And so it's not going to work as smoothly. And so this is definitely a year to buckle up. But I think it'll be a positive year. Our work shows, given what we've seen from a historical standpoint, where valuations are and where earnings are, you can make money in this market.